Hi everyone, this is Rob Roy and welcome to the Elliott Wave Options S&P 500 US market update. Obviously a big down day in the markets today after coming eerily close to the Wave 3 Supercycle high that we talked about back in our Elliott Wave Outlook for 2020 recorded in January. So it begs the question, was today just a test by the shorts or is something more sinister afoot? Let's take a look at the charts and I'll show you what I mean. If you're new to the channel, be sure to subscribe to get all the market updates before the next trading session opens. For our timestamp, it is 11:50 p.m. Eastern Time on Thursday evening, and the futures are currently down 18 points. We had another downtick right when the futures opened, following through with the downward move in the markets today, and then they've kind of leveled off since then. In Tuesday night's Trade Finder, I made the comment that people should begin to get a little cautious on initiating new bullish positions. And here was the reasoning why. We had this nice 45-degree angle move, and if you heard me do any recordings, you know that I really like when a market, a security, etc. moves in a 45-degree angle. And the primary reason for that is they tend to not give as volatile of corrections. So we know nothing goes in a straight line. Well then, once the market moved to new highs, we started to go a bit more vertical. And that's when you start to get concerned about a little bit more significant pullbacks. So it looked that way on Tuesday evening, and then yesterday we get this big upward move, and like, yeah, good comment, Rob. But honestly, we got eerily close. I mean, the high of the day was 358.75. And if we go back and take a look at our Elliott Wave Outlook that we did for 2020, you've seen that recording. Hopefully, you've watched it when we talked about moving to the 346 level. But we also showed this Wave 3 Supercycle in the markets on the SPY monthly chart. And so you can see there's the wave 1, 2, 3. Supercycle is a multi-decade thing, so we're going all the way back to 1993 with this chart. And then the obvious question becomes, well, where does the wave 3 end? That's always the question. Next level would be 2.62 times wave 1, which gets us to 361, or basically 362 on the S&P. So that's where we're talking about. That could be a very major top. If we break through 346 and we hit 362, then what happens? Well, and we're less than 4 points from there in yesterday's high. So where do we go from here? Well, a potential move to the downside would be back to the 161.8%. Now, this is just speculation here, but the wave 4 could easily correct back to the previous fib level. That would follow Elliott Wave Fibonacci rules, and that would bring us into, 2025 or so on that pullback. So that wouldn't be a very fun few years. But note where the wave 3 is. Look, it's kind of right in exactly where we are now, and we did this back in January. So even with the coronavirus, we're almost right on the timing with this wave 3 forecasted move to the upside. So going back to the current charts with where we are now, that was yesterday's move, and then boom, you all know what happened today. Well, one thing that's interesting is if we take a look at where we actually were with the 346 level, it's just kind of right through here. So we closed just around where the 346 level is. So is this just a test of that previous level that had 3 different Elliott Wave patterns, or are we headed to the downside? If we take a look at a couple of our indicators, first volume, well above average volume, and then taking a look at the DMI, we also talked about this in Tuesday night's Trade Finder, that the ADX was flashing signals that, hey, be careful, the strongest part of the trend is over when the ADX is above the positive directional indicator and you're up above 40. It's been a pretty good run. Now, I mentioned in the intro that is this just a test by the shorts? Now, what I was talking about along those lines is the fact that the shorts will step in and they'll test the waters. When they're getting ready to unload, they'll kind of come in a test run, if you will, soft launch, whatever you want to call it, and they'll see how much resistance there is to the downside. And that gives them an idea of whether or not it's time for them to really come in a bigger way on the short side and press things to the downside. Another thing the shorts like to do is give something like this, like a bit of a head fake. Let's put the moving averages on here. You can see we did close below the 10-day moving average, let the market bounce back up for a couple days, and then it just reprograms the retail traders. Oh, it's buy the dip, it's buy the dip. Hey, we're happy, we moved to the downside. And then that gives them further ammunition for other drops in the near future that'll be bought into, so that's more for them to sell into. Those are two scenarios that play out by the shorts. The shorts are savvy. You have to be careful with them when you're trading to the long side, especially when we're in a scenario like this where we're been on just one heck of a run. I also wanted to show you a couple of other levels if we are starting to pull back. Here's that monthly chart of the S&P again. So I put on this chart the 38% pullback in just the last leg of that super cycle move, and that happens to be 249. Well, guess what? When we go back and look at this chart again, where the 161.8% fib extension level was on the way up, guess where that is? 249. So now we have two different scenarios giving us the potential for a move all the way back down to roughly 250 on the S&P. So that obviously wouldn't be a whole lot of fun. Now there's the 23.6% fib level in there that could hold if this isn't going to be anything worse. But another kind of scary note here is this is an expanding triangle. So we have contracting and expanding triangles. Both of them yield breakouts. And so we could have a breakout to the upside or the downside with this type of pattern. So caution everywhere, which is why in our portfolio for our subscribers, we have the volatility portfolio that has strangles in it with everything has a long put in it, act as protection. If nothing else right now, you should start to put some protection on your portfolio on your bullish trades. Also wanted to take a look at the VIX. We had been talking about this big descending triangle for quite a while. You go back and look at the previous recordings, and there's lots of them there. We got awfully close down here to filling this gap. Didn't quite fully get there, but pretty darn close. And that explosion to the upside is not what you're wanting to see if you're long the market. That was a big move. So maybe that calms down a bit, but if you are, again, long, you don't want to see anything like that occur. So we focused on the market and the VIX in this recording because today was such a significant day. In following recordings, we'll get back to talking about the dollar and gold, etc. Dollar's been a little bit stable, actually bounced a little bit to the upside today, but it'll be interesting to see tomorrow. Tomorrow's a key day, and if we get any follow through to the downside, then maybe there is something a bit more sinister afoot, as I said in the opening, or if we bounce back to the upside, then that still gives the little caution of, was this a buy the dip, or are the shorts just setting the retail traders up for the big drop? Hope you're doing well, and we'll look forward to talking to you again next time. Take care, everybody. If you like these recordings, I'd like to invite you to join our new Trade Finder Live, where each and every week we do a live webinar where we talk about the market, but we also go a little more in depth into the technical analysis system that we utilize to forecast where the market's likely going to go, and also to identify trading opportunities. Get your free subscription today. Take care, everybody.